Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in today's video we're going to talk about ASML. ASML is a leading supplier of semiconductor manufacturing equipment. We will talk about the company's financials, we will talk about the growth prospect, we'll talk about risks, and then at the end of the video I'm going to talk about the valuation right now, because that's something that has been discussed for a while. So we want to see, because the stock has come down quite a bit, where is it right now? Is it overvalued? It's still undervalued? We want to see basically where the company is at in terms of valuations. And of course I own this stock, so I will tell you exactly what I'm going to do inshallah moving forward. But before we get diving into the company, I want to say to you guys, everyone that has joined the community on in terms of the Patreon account, thank you very much, because genuinely makes a huge difference. If you haven't joined us, you get access to a lot of things, all the buys, all the sales for the family portfolio, for my own public portfolio, as well as of course the dividend trackers. You get access to all the monthly undervalued stocks, and you get access to the high quality stocks that are normally put up. And then of course you got all the different trackers and so on, dividend trackers and so on. So you get a lot out of it inshallah. Come and join us inshallah. There's community of people basically in the Discord that are genuinely sharing good practices on daily basis. So now let's talk about ASML. So like we said, ASML is one of those companies that develops, produces, markets, sells and service basically advanced micro semiconductor equipment. Okay, so those semiconductor equipments is basically what you see here, cost about 380 million each, and their main basically companies, okay, the main these customers if you like, is TSMC, Intel and Samsung. These are foundries, these are the companies that make those chips, okay, and majority of their stock basically products are sold to these companies. Now as you can imagine, all of these companies have now got a basically they have, especially these two, actually all three of them have a manufacturing in the US that they recently started, and they need products that this company creates. Now of course, there will be years or times where they not buy new ones, but what they're doing is, of course, they servicing the ones that they've already have. So whether they're servicing or whether they're buying brand new and building a new factory and they need all the brand new equipment, or moving up technology-wise, they actually buy new ones because it is a more high-tech, more better, whatever. Okay, the company that provides all of that is ASML. This is why I always say to you guys, this company is probably one of the best companies out there in terms of it has a wide moat like no other company has. I can't see any other company coming into the market for the next 10 plus years to take over from this company. Now there are of course some headwinds, there are some situations that we might not like, and that includes the export license requirements, which actually was published about a week or so ago. So the Dutch government has updated its export license requirements for this company, especially to places like China and so on. So that can impact the company's sales in the future. So that's something that we need to watch out. That might happen next year, the year after, 5 years from now, but something that we need to watch out and see what actually the company says the next time the company reports. Okay, we've got this CEO transition, so they basically have appointed a new CEO starting January 1st. So that could be a good thing, that could be a bad thing. If the person who's currently leading has been doing absolutely amazing job and they retire and someone new comes in, anything can happen. So that's a bit of a risk. We'll see what basically credentials they have once they actually get appointed, once they actually join the company. The other final thing I want to talk about is China. China has been a massive situation for this company, and it said on Tuesday that basically it expects net sales for Tuesday of the week that they reported, by the way. They've said for 2025 to come in at the lower half of the range it had provided previously. So based on what they've said before, they went back and said, oh, sorry, we expect less than, okay, so half of the range that they provided previously. And a lot of that is because of, China maybe slowing down. The fact that is China and the US are not getting along when it comes to basically the chip side of things, and anything can change, anything can happen. So we just need to watch out these things. But again, these are not, as a long-term investors, this should not affect us as much, and I'll tell you exactly what I will be doing in the next few weeks inshallah at the end of the video. But I will tell you exactly what I will be doing for the next few weeks. But I'll tell you at the end of the video, inshallah. And now that out of the way, we just need to look at the financials and see if this company is actually a buy, a sell, whatever the situation. We just need to look at the details. Okay, so as you can see here, year to date is actually down almost 11%. For the last 6 months, it's done about 17%. And as you can see here, it's actually now getting closer to the 52-week range. So $631 per share is the range. 674 it is basically exactly where it is right now. So we're coming back down. Remember, it was at one point over 1,100 US dollars. So it has come down quite a bit. Now it has a forward PE of 32, but we need to look at this in conjunction with the 5-year average and see where the company has been over the 5-year average. The other thing I want to look at is financials, because it's important to know how this company makes money, okay, where that money comes from, how much of that money actually becomes a gross profit, how much of that becomes a net income or free cash flow, and so on. Okay, so as you can see here, if I kind of zoom out, okay, you can see here in 2024 and 2014, sorry, it was $7 billion in terms of total revenue. Then it became 6.8, 7.2, 10.7, 12.5, 13.2. Even COVID time, it actually grew about $17 billion. Okay, $21.1 billion, 22.6, 30.4 billion dollars, and right now 29. Now, so it has come down a little bit, and that's probably one of the reasons why some people sold this stock and they don't want to hold it anymore, which is absolutely fine, right? Then you've got in terms of the cost of the revenue, so how much it costs is, but then they take home the gross profit, if you like, of almost $15 billion. Now, after they paid some taxes, there is basic research and development, which is very important to this company. Okay, for that 1 year, they spent $4.7 billion, which is absolutely amazing because it is a growing company. It's not going to stagnate or whatever. Okay, then we've got the net income of $7.7 billion. So there, from this, okay, from that $15 billion, the net income is now $7.7 billion, and we will see the free cash flow in a bit. The other thing I want to show you is the EPS side of things. As you can see here, the basic EPS, that if we focus on just this one here, $3.9 per share to right now almost $20 per share in this space of 10 years. So this is a high growth company. It has been growing massive, basically quite a lot over the last whatever years. So what I'm going to do now is just kind of put all of these things into one basically thing, and we'll take it from there, inshallah. Okay, so as you can see, semiconductor materials and equipment, the company currently trading 674, EPS of $19, 250 billion market cap right now. It has a wide economic mode, and like I said, this is probably one of the best companies when it comes to having a wide mode. Okay, we've got beta of 1.5, slightly high, current PE for 35, the forward PE is 32. We've already seen that. The 5-year average has been 42, so you have to take that into consideration. Based on that, it actually looks cheap. Now, the price to free cash flow 82. The sector, the basic information technology sector, is right now 26.5. Now, in terms of dividend yield, they have 1.22% in terms of dividend yield, and right now, as you can see, they pay $8.24. I'm not sure if this is correct, because let's go back here. Let's go to this thing here and see. Okay, so we got less than 1%. And I don't know why this information changes depending on what website you look at. $6, yeah, that's what I thought, $6.60. Let's go to Seeking Alpha and we will see. Just want to cross-reference because this information here comes from this website called Dividend. Okay, so I want to check this. There we go, 671 and just less. So this is possibly correct. Okay, so yeah, so there you go. So that just ignore that, but just about 1%, and you got about $7 or 6 something. Okay, payout ratio is 10%. All of this comes from by Simply Safe Dividend, by the way. And latest increase was 4.8, which is fine. 5-year growth rating basically is 24%. Now dividend streak is 14 years here, but it's 1 year here. Like I said to you guys, I'm not sure why there is a bit of a difference, but it is what it is. Even if it's 1 year, absolutely fine. You got the last 5 years about 24%, and this is one of those probably companies that are not really interested in increasing that dividend every single year, and I'm not in it for the dividends anyway. Okay, Safety 82% according to Simply Safe Dividend. Free cash flow right now we'll be looking at $3.2 billion. So that is basically the $7 billion that we've seen already of that net income, and also they also have basically manage basically $3.2 billion of free cash flow right now. So that's slightly different net income and the free cash flow. The free cash flow compound annual growth rate for the last 5 years, we're looking at about 21%. It's really important. Companies that have excellent free cash flow margins and so on are very important to me, because I know they're not going to cut that dividend. They're going to grow that business. They're going to buy back their own shares, pay off any debt that they have, acquire other businesses. There's a lot of things they could do with that, right? So free cash flow right now, we're looking at a yield of 1.2. Normally we're looking at over 3%, but that's fine. Free cash flow margin of 11%. Now, in terms of the profitability, this is where the company shines. No issues with profit margin, operating margin, return on equity, return on invested capital. Absolutely all amazing. And the net income compound annual growth rate for the last 5 years, we're looking at about 28%. The total return, including dividends and price appreciation, we're looking at about of 22% over the last 10 years, which is absolutely amazing. In terms of revenue side of things, in terms of EPS, we're looking at about 19%, 33% in the last 5 years. And then current ratio, we're looking at about 1.55, which is absolutely amazing, because what we're looking for is anything above 1, which means the company has enough basically liquid assets for right now to pay off any liabilities that they have in the next 12 months, which is quite nice. Now, the EPS growth estimate for next year, is 26%. The revenue growth for the next year is 16%. And this information comes from, just to kind of give you an idea, is the estimates from here. So we got that 26% and we have that 15% from Seeking Alpha. Okay, current price we've already seen. According to Morningstar, the price they're expecting is $935 per share. Morningstar is saying it's about 28% discounted right now. According to Simply Say Wall Street, they say 980, basically 6, which is not far off, and that's about 31% overvalued, basically undervalued at the moment. Tip rank for the 12-month price is more or less the same. Again, 36%. Okay, strong buy. Same more or less when it comes to Seeking Alpha. And again, it's a buy rating from them as well. So all of them more or less agree, and I genuinely agree with them. Okay, from Sharia compliance side of things, no issues with here. We will look at the valuations in a second, by the way. And then shares, basically they're buying back their own shares, which is quite nice. Now, if we compare this company with the S&P 500 or for the last 5 years, as you can see, the stock has returned 161%, and the S&P 500 just 87%. Over the last 10 years, you can see 648. Right now, the S&P 500 is 181%. So they definitely beat the S&P 500. And for the 1 year, of course, basically the S&P 500 is actually doing better. A year to date, it will do better because we are down quite a bit. For the last 3 years, it's also done better. But when you look at the 5 years, when you look at the 10 years, okay, the company has done an absolutely amazing job. Now, what we now need to do is to look at the valuations for this company. So we've got the Morningstar valuation, we've got the Seeking Alpha valuation, and we've got Simply Wall Street, and then discounted cash flow model that I used. Okay, put all of that together, average it out, you got $997 per share. That's basically similar to what these guys are suggesting, so in the 900 range, right? Current stock price is basically $674 per share. That gives us 48% upside from where we are right now. If we say, for example, this stock is very risky and we are going to basically need 15% or even 20% or even, let's even say 30%, okay, you're still not there. So in my opinion, it's still undervalued. Okay, now to be honest and be transparent with you guys, I'm just going to show you my holdings for this company, ASML. There we go. And as you can see here, I'm down just over less than 1% for the first time, because the stock, remember I've added it to it recently. So 600, my initial price used to be 600 and about 602, I think it was $2, but right now it's $652 per share. That's basically my average, or 526 pounds. So what am I going to do? I will be buying. Okay, I will buy 1.5 shares of this company before it I don't care what happens. Okay, I'm gonna buy another share and half to round it up to 10 shares, and I'm gonna leave it alone. As you can see, a lot of that gains and loss basically is the FX impact, so that's over 4%, and that's probably why I'm down. But overall, generally, this is a great company. It's a great business. It's been around for a very long time. It hasn't basically, when you look at the basically the moat, for example, for this company, is absolutely amazing. And by the way, there will be some headwinds. There will be some situations where we're not comfortable or what's happening moving forward. But in the end of the day, that doesn't really matter a lot. So things like, for example, the stock, the machines that the company creates, okay, last more than 30 years. And all they then do is make sure that they actually maintain it, the services, okay? So basically, this provides recurring service revenue, which is quite nice to see. So the switching costs, okay, and the intangible assets required to displace these machines are enormous. And that's one of the reasons why a lot of the companies that invested in this business or basically bought this product are stuck with this business, okay? So to switch from ASML to any other company, it will be huge cost for these companies. Now, the other thing is, because it's high price product, could be a lot of problem for a lot of companies. And also the other thing is, if they don't innovate, okay, according to the bears, for example, if they not an innovative company in the next few whatever years, and the machines are not good enough to produce the next best chips, of course then they're going to find alternatives. But right now those alternatives do not exist, in my opinion, and hence why I'm going to continue buying this company, inshallah, in the next few weeks. I hope this gave you some sort of value. If it did, please like the video, subscribe to the channel, and make sure that you join us in the Patreon account, where you get access to a lot of these things. Okay, there are a lot of news about this company right now, and you can find it on YouTube, on Google, and just a quick search, and you will find out a lot of the things that are happening to the company right now. But that should not stop you from being a long-term investor, because that's what we need. The most important thing for us is that what might basically with the situation with China and the Dutch government, whatever, that could easily go away. But what we need is to be a long-term investors and invest for the next 5 to 10 years. And if that's your goal, then why are you worried about when the new trainers, shiny new trainers come out and they are discounted prices? We're all jumping and buying them like 200, £100 of trainers, whatever, right? But when stocks are down, especially stocks like this, we don't actually invest. We actually sell them rather than or trade it or whatever the case might be. So be mindful, be careful, be a long-term investor, inshallah, and think about your generational wealth rather than just making a quick £1, £2. I was up a couple of £1,000 not long ago with this company. Right now it's down. Gave me opportunity to buy more, and I'm going to leave it alone and hold on for a long term. Now, I'm not a financial advisor. Do your own research, but please make sure that you're always doing your own research, inshallah. Have a wonderful day. Assalamu Alaikum.